Welcome to the Your Money Personal Finance Podcast. I'm David Pratt, along with the president of Everything Financial, Peter Cishecki. And on Season 2, Episode 13, we're going to go over the 10 key questions on property insurance, or as we like to call it, Property Insurance 101. Now, to do that, we are joined with the founder and CEO of Alteri Insurance, Joshua Krenus. Welcome to the show, brother. Welcome to the show.
Yeah, thanks a lot, Dave and Peter, for having me. This is exciting. I love it.
Now, you knew I had to bring in an expert on this, Dave, because this is way above my pay grade. That's right. When we're doing financial plans and people say, what about property and casualty and all that things? I said, okay, talk to Josh. Don't talk to me. I'm referring you to Josh because he's an expert and he does mine and pretty much all our staff and a lot of our clients. So I appreciate you, Josh, coming on here and making this easy for us people who don't get this stuff. Making it easy for us.
Yeah, no, absolutely.
Yeah, I'll be listening too a lot and taking notes.
Yeah, good. Oh, I better not screw it up.
Yeah. Well, let's get into this thing here. Okay. We're going to start with this simple question. What's the difference between replacement value and depreciated value?
Yeah. So in insurance, we usually, we refer to them as two different things. And the reason I'm going to bring this up now is because you're going to see them on insurance policies. So you're going to see like RC versus ACV. And what that means is replacement cost versus actual cash value. So let's talk about replacement cost. Replacement cost is a superior coverage. It replaces the item that is now gone. And the example I always use for replacement cost is something materialistic. So let's say you bought a new camera, Sony camera, in a few years back. Bought it in 2019. And in 2022, it gets stolen and it's covered. They're going to buy you that same model in 2022. So you're getting a brand new camera. It's the same camera, but you're getting a new one. That, as opposed to actual cash value, that would be if in that camera example, if it got taken away, it takes depreciation into an account. So they'll either pay you out for that camera for a 3-year-old one that they can find online and what that average value is, or they'll send you a 3-year-old Sony camera if they can get their hands on one.
Ouch.
I got a question. What's a camera? Since they're all on our phones now.
Right?
I'll re-ask that. I was like, what about an iPhone? Can we do an iPhone on this thing?
Yeah, what about an iPhone? Yeah, you're going to want to replace that one brand new for sure.
Like I said, off the kick here, it's an education for me as well, as I'm learning a lot of a new language here. And here's another part of it, okay? What is comprehensive coverage? If I look a little confused, help me.
Yeah, no, for sure. Comprehensive coverage is like a form of coverage that you use in insurance. So if we just stick to homeowners insurance and commercial property or whatever, you're going to have two different forms. You're going to have comprehensive or broad. Those are the two forms. Yeah. Comprehensive is the superior coverage. It covers, it's what we call all perils. So basically any peril that happens, it's going to be covered within reason. Broad form is like named perils. So it's only what's listed on that policy. If we're getting technical, there's 13 of them. But essentially it covers all the big ones. It covers like fire, water damage, smoke, theft, etc. But what it's really good for is not only does it cover all perils, but there's really important things in there that it covers for not that much more expense, like mysterious disappearance, for example. So that's really big on jewelry. So I don't know if you've had friends or whatever, maybe engagement rings or wedding rings go missing, and you don't have to have a theft reason or anything. You just have to have proof that you owned it, and under comprehensive coverage, it's covered. So things like that, it's in the wordings, but it's definitely worth it to go that way.
Okay, Josh. So comprehensive coverage, after hearing your explanation there, would that always go hand in hand with replacement value, or could you get comprehensive but still have the depreciated value tied into the policy?
Yeah, it's a good question. You definitely can mix and match. Generally speaking, you don't have a choice. The insurance companies are going to put them together with regarding whatever you're trying to insure. But like if you have a home, for example, that it can be broad form and replacement cost. So you can have a home that's going to be $1 million to insure the structure. That's broad. So it doesn't cover everything necessarily. So you can mix and match for sure.
Okay.
Now, I want to get onto this, which, is a little scary here for a second here, but should you get earthquake coverage? Really?
Yeah, I mean, that's that I think it depends on not only anybody in the industry, but everybody buying it. I think everybody has a different answer.
Okay.
But in BC, I bought it for my home. I don't know if it's right or not. I think it depends on what the value of your home is in premium dollars and what that costs to add on. So are you going to stay in that house for like 20 years? And if you did lose that home, and you talk to your financial expert, Peter, there, and you realize you can't sustain that loss given your savings or your financial plan, then I would urge you to get earthquake coverage. If you're an extremely wealthy individual, and if the worst did happen and you'd move to another property, or you could simply live somewhere else while you rebuilt, then I would probably say no, because earthquake premiums are starting to get quite up there, like very up there. They're matching the base premium. So let's say you have even a broad form policy for your property, and let's say you're paying a couple $1,000 for the year for your house, you're going to pay another $2,000, sometimes even $3,000 for the earthquake. So it's considerable.
Now, correct me if I'm wrong here, Josh, because I've seen it and I had it on a house before. Isn't the deductible on earthquake insurance about 10% of the cost of rebuilding the house? So if it cost you, well, you used $1 million example a minute ago. If it cost you $1 million to rebuild the house, isn't the deductible like $100,000?
Yeah, it's a good question. Short answer is yes. Deductibles are in percentages with earthquake. So you're going to be at 5, 10, 15. Honestly, I've seen 25% deductibles. So if you, like most Canadians, own a structure that needs to be rebuilt worth, honestly, 400 to 500,000, and you have a 25% deductible, a lot of people can't even afford that deductible. So in that sense, I'd say just don't even put the earthquake on. It's pointless. But obviously that deductible affects what you're going to pay at the end of the day. So if you can get lower.
Yeah. If your house gets destroyed and collapses because of an earthquake and you don't have earthquake insurance, you're screwed.
You're hooped. Yeah, you're absolutely.
So here's the worry though. What if the earthquake causes a gas leak and the house goes up in flames? Was your house destroyed by fire, or was it destroyed by the earthquake?
Yeah. So fire following earthquake is covered in insurance policies, both in broad and comprehensive. But the earthquake damage is not. So if you can imagine, let's say
Dave and I both look like totally puzzled.
I know, like let's say your roof collapses, and I'm just making this up, and because of the earthquake, but the whole structure goes on fire, they'll say like, "Okay, we won't replace your roof, but we'll replace, everything that was burned."
So what you're really saying, Josh, if there's an earthquake, get everything out of the house as quick as you can afterwards, before they come to check, the insurance company comes to do a assessment or whatever they exactly do, an investigation. Oh yeah. And torch it at the same time.
Yeah, they'll be too busy to investigate the fire, so just light it on fire as soon as you get going.
Well, we were cooking, we were doing a barbecue, and the earthquake hit, and the grill went everywhere, and the gas line snapped, and we ran for our lives. But thank you, Mr. and Mrs. Insurance Company, for replacing our house.
Yeah, and honestly, I don't know how on earth they could possibly investigate it, and I have clients obviously that don't believe that insurance companies would be able to sustain such a loss. I am not on that track. The reason being because these Canadian insurance companies are not, they're just so heavily regulated, and they're also so well spread out. Like, the Intact, Aviva, Wawanesa, they're just across Canada. So if there's an earthquake in BC or even southern BC, to them it's a lot to you and me, but not to them.
I'm going to ask a question here that a year ago, I just would have rolled my eyes and said, okay, let's just get through this and let's move along to something that really matters. But a year later, and the world that we've known has changed, to say the least, a lot. How about flood insurance? Let's say I own the seawall. Would that come in handy? Whatever the case is. How important is flood insurance now?
Or a farm in the valley.
It's on my list.
Yeah, in the valley.
Yes,
sure.
Exactly.
Well, let's talk about what that means. Because, a lot of people, I think they get confused around what water means inside of an insurance policy. So when you're talking about property coverage, water is water damage is water that happens from inside the house that affects the house. So your sink, your bathtub, your toilet, whatever, and floods everything. That's water coverage. That's included in both broad and comprehensive. So water damage is always covered. When you talk about flood, we're talking about kind of two different things. We're talking about sewer backup coverage and overland water. Those are the two things you need to add to your insurance policy, especially in BC. So when you talk about overland water, it's exactly how it sounds. It's water from outside coming into the house. So the only caveat there is it has to be fresh water. So like it can't be like a tsunami or a tidal wave from the ocean. That's considered an act of God. If it's just a flood, like raining and floods and comes from outside in, you're good. Sewer backup is when there's like a city line or a sewer backup line and it comes into the house from outside. So those are the two things you're going to want to add.
So you have to buy those separately.
Yes, you do. And it's really, the sewer backup one was, in my opinion, they just changed that not too long ago. And that was a really tricky, they even have separated now city line coverage versus sewer backup coverage.
Wow.
And we're still trying to get that right because we're just, we're trying to understand, okay, so non-city line sewer backup versus city line, it's starting to get super confusing based on some insurance.
It's coverages. Funny when I call you in a couple of months when my house is finally finished, and it's because when it was being built up Whistler Way, and all that rain hit, and Pemberton had some evacuations then and everything else. But I'm on a mountainside, and the first thing I did was phone my builder and said, "So what's the situation of the house?" And he said, "Well, there's a easement beside and a big pipe." And he sent me a video. There was barely a trickle of water out of it. And with all that rain, just because it's all rock and it drains really well and everything else. So the overland, even with that record once in 100-year type rainfall, was horrible. So what you're saying though is all those poor farmers, if they had the rider for the overland water, they were good. If they didn't, they're in trouble.
That's exactly what I'm saying. And I think there's a lot of, upset people out there, obviously and probably at their brokers too, because that's an endorsement. That's just like so crucial. And that's why I was saying the Valley, because the Valley is
what used to be a lake.
Typically our most claims.
Right.
Yeah, exactly.
The whole Sumas Prairie flatlands there, I don't know what it is, 100 years ago or 120 years, whatever that exact time is, was a lake. So if you have a farmland and a house that used to be in the middle of a lake, and it is fresh water, exactly. You may want to buy extra insurance. I'm just thinking, might be a good idea. Just saying.
No, exactly. Yeah, I'm with you.
But wow. The thing is that to understand the difference, and I want to get some clarity on this, okay, between the flood coming from inside or outside your property. I mean, to me, we're splitting hairs. That the water came from my lawn. No, it came from my next door neighbor. I mean, this to me is it's splitting hairs. But I mean, I understand it. Once you start talking money, that's what it gets down to, exactly what it says in the contract. And how careful do you have to be about knowing the difference between the two?
Yeah, no, absolutely. You have to be super careful. And really, it does, at the end of the day, all this stuff does get really tricky. They do, like if you're doing if you have a basement that's got carpet in it and like it's like basically an unfinished man cave, and it's like $5,000 worth of damage, they're just gonna write you that check, right? But if you're claiming a flood that's in the six figures, then yeah, they're gonna make sure that's covered properly, and your agent kind of needs to help you with that, to be honest.
And aren't I correct, Josh, that even going back to the beginning here, our first topic, the replacement value, isn't the cost quite like it's not that bad? Like the difference in cost from a replacement value to kind of this depreciated value and comprehensive, from what I know from dealing with you and your company, it's not that big of a deal. So isn't the onus really on the broker who's giving you the thing? Because when people ask me when I'm doing their financial plan with their Omni formula, and I advise them I don't sell this and I refer them to you guys and whatnot, And basically what you've taught me is and what we do is teach our clients to ask the right question. But as I say to them, unfortunately, and there's a lot of good brokers out there, but like anything, there's also a lot that aren't good. And a lot of times they're selling on the path of least resistance, which is the cheapest policy, not realizing for 5% more, 10% more, maybe. I don't know. You'd have to be, I guess it varies. Obviously, you can't commit to a number, but I know it's not significant to go, geez, you can cover everything. Like the Bentley, no, not commenting on Dave's dog or my dog,
okay,
because we both have a dog named Bentley. But the Bentley coverage and the 74 Pinto coverage isn't that much different in this case.
No, it's not, and it's not. It's not even as far as coverage offered. It's not even that drastic between those two vehicles. It's it's more like a BMW to a Porsche or something like that. It's closer. So okay. And the cost is there. Honestly, sometimes this is going to sound extreme, but it's actually true. Sometimes insurance companies offer broad coverage more expensive than comprehensive coverage because they're worried about future claims of that broad coverage. Because broad is kind of leaving because, people get upset when they didn't realize they could spend an extra $100 a year and have so much more covered, right? It seems silly to me.
Well, hopefully from this, we got lots more topics, Dave, I'll let you get into. But the whole point is, we do with these podcasts is to educate people to ask the questions they didn't even know they're supposed to ask. And this is key because you said in the grand scheme of things, you spend so much money on insurance, but if the difference is only a few bucks, get something that's actually going to pay you, because you know what? I don't recall anyone whose house burnt or house flooded or they got robbed complaining about their premium then. They just, it's the peace of mind. Like when we do a disability policy for someone, we do the better coverage because we tell people you don't want to be arguing with an insurance company when you really need the check.
Yeah.
And everyone blames the insurance company because it's easy to blame them and we all like to, but buyer has to take a little responsibility to ask the questions and make sure they're getting. Don't just make your buying your insurance coverage just a 5-minute thing you do on a Saturday once a year because it came up. Like, put a little thought into it.
No, I totally agree. And one of the things you had said earlier is that you got to be careful, with the people that you're actually choosing to let into this world because of your decision making. Because when things go bad like this, like we had a lot of coverages, a lot of people call us obviously when the floods happened, especially. And, even just to make sure that they answer the phone, because it's your biggest investment, your livelihood, obviously. So you gotta be careful. And, I would stress that you look into that before you decide who you're buying from as well.
Well, to expand on that sort of investment aspect of it all, and this again was something completely off my radar till we started going through all of this, and I said, okay, hold on here. You've got tenants and rental coverage. How important is this? You talk about something that was not on my mind at all, but you tell me, how important is it, whether it's tenants or rental coverage?
Yeah, I think it depends on what situation you're in. I'm going to say yes because I'm biased, because I think insurance is great, if especially in certain instances. But if we talk about tenants or rental coverage, that's really important for different segments of the market. So if we talk about someone like Peter, let's say he's building a house somewhere, and he doesn't have a secondary residence he has to go to. He's got to move and he's got to put everything in storage, and he's got to wait for that house to be built, and then he's got to move over. While he's doing that, his home is now gone, and his home is not necessarily about all the contents. Even though it's in storage, you don't want to make sure all those contents are covered. Let's say he's got some great art and he's got really nice furniture and stuff. Obviously, you want to have that covered while it's in storage. But what's really important is the liability. You want to make sure that if someone comes after you for property damage or bodily injury, which is a global coverage, by the way, so you can be traveling and cause damage or hurt somebody and they can sue you, even if you're like on vacation or whatever. If you don't have that tenant's coverage in place and you're building that house, you have no liability to protect you. And you could have spent $250 for the year to have this coverage in place.
Wow.
For things that cost millions of dollars. So when people think tenants and renters, they often think contents. They think they're like synonymous terms. But I think of liability because, there's just everybody sues everybody for whatever reason they want to. They don't have to be right. And, it's something that's just so easy and cheap to tick off. So I think it's very important.
Like the burglar breaks into your house, slips on something on the floor, ends up a quadriplegic, and he sues you because you had something in your house that was dangerous and he fell on it. Like you actually hear stories like that, especially in the US too, I got it. Probably in Canada, I don't know, Josh, but I've heard stories like that.
One of the
and it's like,
one of the better ones that we had. Yeah, one of the better ones we had to help was we had a lady who was attending a wedding, and one of the people that was working at the wedding had slammed the door as she was leaving on her finger, and she actually had to have one of her fingers amputated.
Oh.
Yeah, and so she sued the venue, the bride and groom, the people who were working the door there. I think it was actually the valet guy that did it. And she named all these people in the suit. Yeah. She named all these people. And I guess the takeaway from that is the bride and groom were devastated, obviously, but they actually claimed their liability through their home insurance because it's not like they have their E&O handy or anything, or their CGL handy for their business because they weren't working. They were just having fun. So they claimed their liability through home insurance. It's kind of a cool example.
I heard that story. I think the lady was ticked off because she no longer had that finger and she couldn't flip anyone the bird anymore.
Oh, is that it?
I don't know.
Yeah, one of the angry ladies. Yeah, exactly.
Oh, yeah, okay. We're going down that road, are we, Peter? Is that
why
where
not?
we're going with this? Okay. I'm gonna get back over here just for a little bit here. Here's the real tough question to deal with. Okay, that claim when you finally make it. Okay, does that just kill your rates going forward? Because insurance companies are real funny about getting their money back. You tell me.
Yeah, it's not good.
Yeah.
That's plain and simple. But the thing is it depends on the size of claim that you're making. So if you're claiming a total loss on your house, which we've done a few times through our agency, and I don't know why the insurance companies do this, to be honest. I should talk to somebody about what the mentality is behind this. But if you ever make a claim that size with an insurance company, like we had one this year that claimed about $395,000, and they just paid it out. They didn't rebuild. That insurance company forces you to go to another insurance company. Like they will not insure you ever again.
Really?
And my theory is like, why would you not recollect again? Like, I mean, this guy had a house for 20 years in place, paying his premium every year, and he claims, and now you're going to kick him out? Wouldn't you just want to keep collecting rent from this guy?
Not only that, Josh, if you keep the guy, you keep collecting your premiums and you look after him, how many people is he going to say to them, oh, XYZ insurance company looked after our claim. They did a great job, blah, blah, blah. I would insure with them in a second.
Oh,
absolutely. I collected my $395,000. They tossed me to the curb.
Yeah, exactly. There's a couple caveats here. So if you're dealing with one of the bigger insurance companies like Aviva or Intact or something like that, Aviva has something called a worry-free bundle, and Intact has like this claims advantage. So if you have your first claim, regardless of its size, and you have that rider on there, which is usually like $20 for the year, it's nothing. Again, it's something your broker has to bring up to you. Then that won't affect your next rate at all. It's irrelevant. So if that's added on, you're fine. But if you are in the first 5 years of your policy period and you make a jewelry claim for like $50,000 to $100,000, yeah, that's really going to affect your insurance. But at the end of the day, it's what it's for, right? I mean,
yeah.
Some people look at insurance like, hey, if anything happens to any part of my house at all, like I'm going to get the lowest deductible possible. And if something happens that's $1 over that deductible, I'm going to use it. And then there's other people that are like, no, it has to be catastrophic for me to use it. So put the deductible as high as possible. And if I have a total loss, I'll claim. So it depends on your mentality, I suppose.
Here's another question that kind of goes down that road in terms of big surprises. somebody breaks into your house and cleans it out. I mean, theft coverage. I mean, how does that work? How do you get covered that way?
Yeah, so theft is covered in both instances, in comprehensive and broad, and basically it has to be obviously, someone outside of your immediate family. It can be friends, but it's basically someone breaking into your home and or the place of storage, wherever you have that place. What do you call it? Temporarily. So if someone steals all that stuff, you're fine. One thing people don't know is that you don't have to have like receipts and stuff for everything anymore. You just have to have proof that you owned it. And a lot of people just take the proof. Like when we sell an insurance policy, a lot of the time, if people have high contents limits, we'll just say, honestly, just go through your house and take pictures of every room and make sure you have a picture of what that is in the house. So go to your closet and just take a picture of your whole wardrobe and just have that one picture. Go to your living room and take a picture of the living room. And if you have all these pictures together and someone comes in and cleans out house, you can make a comprehensive list. You can figure out where you bought it. And we've seen this and done this for clients before, and it works quite well.
Is there and I think I saw this years ago, Josh, but I'm not sure. Is there like a software program or a checklist where people can go in and list, something I'm just thinking for us with doing the financial plans for people, something we could add in to people we just want to point people in the right direction and say, here, go through, list your rooms and try and list what's in each room. And, I mean, I get it with bedroom and clothes. I get you for sure. Take pictures of the closets, but I'm going to need a bigger lens for my wife. Dave, the same thing with Brenda for shoes. Yes. We're going to need a big target for that.
For sure.
Armoire.
Yeah.
Armoire is the word.
But just, for going through, okay, in the living room, we have this, the great room, this, and you start listing all the things off. Is there something out there that people can get that makes that easier? Because I can't imagine with the stress and how you'd feel so violated if someone robbed your house. Just trying to put some of that stuff together, you're gonna think of things 6 months later that you never even thought of.
Yeah, exactly. Looking for the remote and realize, oh, that's not there.
Oh, wait a minute, there was a TV on that wall.
Yeah, exactly. You're totally right. There should be a list. We have an internal one. Is there a universal one that's generally completed when you submit a new property application, commercial or personal? No. And the reason is because, I don't want to get in trouble for saying this, but insurance companies don't really want you to do that. They want you to claim immediately and in panic and miss things because obviously, I mean,
you're emotional.
They want to close that claim out within 24 hours.
Okay, Josh and Peter are going to put together the Everything Financial Alteri. Yeah. Seriously, we're going to work on this after the show. Sure. We're going to put together a list for clients and help people out because I think this is something.
It's a good idea.
Yeah, everyone can benefit from. We'll post it. It might take us a little while to put it together, but I think this is a huge thing for the public to have to make their life easier because just like when we do estate planning and different things we do for people, why not help them if they had, God forbid, had a theft or our next topic, Dave, fire, same idea, right? You lose everything, making it easier to go through so you don't have to think. We have this thing, Joshua, with our Omni formula called an estate directory. And in our estate directory, it's a list of where do you keep all the documents? Who are all your friends, your neighbors? Like it's 4 pages long. It's like your estate phone book, if you will. And I remember people have used this. And the first time this was ever used back in the 90s, I get a call and from a client's son, the dad had passed away. I gave him his financial plan 2 weeks previous and he filled out the estate directory. The guy's mom couldn't even remember, not my name, and I was just there, and I'd known them quite a while, couldn't remember any of her neighbors or her friend's name. So if that happens with a death and imagine the violation of your house or God forbid, your house burns down and you're fortunate enough to, escape and be fine, but everything's gone. I couldn't even imagine trying to get my head wrapped around trying to put that list together. So let's stick it to the insurance company. Let's work on a really good comprehensive list that we can get out there for people because it's only going to help people.
Yeah, absolutely. It's same with inside your car too. A lot of people have a lot of stuff inside their car. They have gym bags that are worth a bunch. They have obviously computers they carry around.
Sunglasses been stolen twice from me when someone borrowed my car and left it unlocked. Yeah. And we thought White Rock was safe.
No, but I want to go another step with where Peter was taking this. Okay, I mean, how do you put a value on certain things? Like, for example, I take a look at my girlfriend's shoe collection, and Peter made reference to it as well. I mean, do you really have to call Jimmy Choo first before you actually make a claim? Or, I mean, it's
Jimmy and
crazy.
I are good friends.
The numbers, because I don't see it until I get my Visa card. Oh, what?
Yeah, exactly. I bet. Well, there's good thing about that. Okay. Is that at least with these things, there is sort of like a concrete value. Like, what this designer bag is worth right now. Like, what she paid for it, and what it is. So if it's some no-name brand, but you paid a lot for it, that's a little bit tricky, but that's a little bit hard to come by in the female world,
to say the least,
kind of brands.
They're a little emotional about that stuff.
Yeah.
Like Louis Vuitton and stuff. We all know these brands.
Well, is that that same one I see called Louis Vuitton? Is that the one?
Yeah, that's the one.
I don't let her go near that store. Yeah. I say, no. Don't look at the light. Stay away from the light. Go the other direction.
Yeah. Don't even slow down. Just keep driving.
Yeah, exactly. No, there's those things are quite easy to value, to be honest, because we know the average value between what they are and how many do you have and where do you keep them, and we can kind of put something together. So, it's stuff like that that's quite straightforward. It's just actually being aware that you need to cover it, right?
One of the things that Peter got into a little bit earlier, but I certainly want to spend a little bit more time on it, and that is fire coverage. God forbid that your house goes down in a blaze and whatever it is, it is just completely destructive on so many different levels, emotional as well as financial. But let's talk about it.
Yeah, for sure. There's a couple things you want to be careful of with fire insurance. Okay. And by being careful, I mean it all happens before the insurance policy is put in place. So insurance companies have something called co-insurance, which means you have to insure the value of that home up to this co-insurance. So generally speaking, it's somewhere between 80 to 90%. A lot of it's 90%. So you have to be paying the premium worth 90% of the value of that home. So let's say you have it, again, we'll use the $1 million structure thing. You paid $1 million to build this house. And if you're not insuring that structure for $900,000 or more, then the insurance company, if a major fire happens, will make their own decision when that happens. So that's a very scary thing. You don't want to be in that, obviously. And it came up before when we were talking about dealing with the right broker, is that a lot of certain agencies and brokers, won't mention too many names, will try to get more business based on changing the premium by changing the top line, which is the value of the home. So, that we all have this internal software that basically calculates the rough value of your home. And then you usually add about 5% just for safety, because it's all technology driven and it could be a little bit behind. So usually it's about 5%. So what they'll do is they'll take this amount and they'll have these other quotes out there that say, oh, that's what he's paying last year. Let's just not do the 900,000 this year. Let's just do like 750 and just go to them and say, you're way overinsured. We ran our stuff and there's no way you could spend $1 million on that house.
Yeah, because houses go down in price in BC, right?
Yeah.
Right.
You may have noticed.
Exactly. Yeah, exactly. So that's one thing to be aware of. Second thing to be aware of is, like, if we just veer away from owning commercial properties or owning home properties. If you own a shared space like a condo, if you have a lot of people, especially in the younger demographic, that they're getting into the market, they're buying a little bit older condos and then they're renovating them. So if you've not only spent a fortune on this condominium, you're also renovating the thing. The insurance company is only going to reimburse you for what you purchased. They're not going to reimburse you for the 100,000 you put into the unit unless you have proof of that. So if you don't have proof of that, then literally it's not going to happen. And it's not even, we're not talking about invoices or receipts or anything like that. You have to have documentation, like photo documentation, that you did that to that unit. And that's a very important piece for, even if you're buying older homes and you're renovating them, you want to make sure that that value is up to snuff. That's for sure.
So what I'm getting is, before your camera gets stolen, take lots of pictures of your house and save the SD card somewhere where it won't get burned or flooded and destroyed, and then you're covered. But I have two examples for you, Josh, that I heard about from clients, and you'll probably be able to clarify these more than I can. I'll butcher them a bit, but we had the big fire about 6-7 years ago on Five Corners in White Rock, where the condo complex built up and there was some businesses below. And one of those businesses I know of, and that's the cafe that's right beside now our office in White Rock, Laura's Cafe, and great lady and great small business owner. But, I was hearing stories from some of those restaurants that were there where she was, burnt down too. And you buy contents insurance for what you have in your business. But over the 3, 4, 5 years, you keep adding things. You add more content, you add more computers, you add more whatever. You just keep adding more things to your business. But she, or the broker, never changed the contents insurance, and the insurance company told her that was fraud. That was the one thing. So what happened is they said, screw this, instead of a claim, they just rebuilt themselves. The other one, though, was from a client of mine who's a firefighter. And I have lots of clients who are firefighters, so I get really, unfortunately, good fire stories. But there was a house that burnt, and then the people had to rebuild the house. And so the example he gave me was kind of interesting. But the people at the end of the day ended up with a bill from the insurance company, and here's why. They had X type of door handles, let's say, in the house. Those door handles could be sourced for $10 or whatever the case may be, but they couldn't get those door handles anymore, so they had to source a door handle for $20. Well, there's a bill for $10 per door handle. And you start to go, that's a door handle. I'm using it as an example because that's the one he gave me. But then you start to go through your blinds, your tables, your chairs, your hinges on the doors, like all these things that were no longer available for the same price. And at the end of the day, the people got a bill for the difference between what they had built it for and now. So obviously, or maybe not obviously, but the house, then they didn't have replacement value. They must have had on the house like a depreciated value. Is that how that would work? Or is this something else inside a fire policy?
They would have definitely had ACV in that case, because they're obviously sourcing something of like kind. They're not sourcing the same one, right? So it would have been ACV in that case. But the important thing is, especially with that first example you gave, is that it's so important to have just a very basic reassessment every year just to see where you're at. I mean, people, especially during COVID, the amount of home improvements that have been made is insane.
Yeah.
Home Depot stock is like through the roof. So you want to make sure that you are really focused on just having those conversations. It doesn't take long. Just have those conversations once a year and just look around you a little bit and see what's changed.
Okay, interesting.
Let's move on to some jewelry here, which I get scared just even thinking about it, but okay. Or whether it's artwork, but let's start with jewelry here. How does that work? How do these riders work here? Because this is a whole different game now.
Yeah. So let's talk about the structure of a policy for property to talk about this. So the structure of a policy is you have your total rebuild cost of your home. Remember, it's not what it costs to buy or anything like that. Like I keep using that $1 million example. Some listeners are probably like, where the hell can you buy $1 million house? You can't.
Hope.
It's yeah. It's not a $1 million house. It's the structure itself. So you've already bought the land for $1 million, $2 million bucks.
Okay.
Now, what does it cost to build that house? That's what insurance covers, because you can't cover the land. Okay. There's nothing there. So if we start with that value, everything below that value, most things anyway, are a percentage of what you choose there. So if you use the $1 million example, normally it's like 75 to 90% of that is contents. So most of the time it's about 75 to 80.
Wow.
So if you have $1 million top line, you have 800,000 in contents. Now that sounds like a lot, but if you actually break it down with everything that's in your garage, and except for the car, and all your furniture and your clothes, and especially if you have a wife with a bunch of handbags or shoes, TVs, artwork, it starts to really, really add up. And it brings me to my point on the jewelry and artwork riders, things like this. This contents limit has, of course, to be more confusing, a sublimit. And a sublimit of insurance is tiny writing inside your insurance policy that says, for all these items, they're capped at this. So one of them is bicycles. Bicycles are capped anywhere from $1,500 to $2,000 per bicycle. And in Vancouver, there's a lot of like $10,000 bikes.
That doesn't even touch the e-bike, so you better get extra coverage.
No, exactly. Yeah, nothing motorized. If you have jewelry, for example, a lot of jewelry is capped anywhere from about $5,000 to $10,000. So again, not a lot, especially if you're talking about wedding or engagement rings. Artwork riders, a lot of artwork is only covered up to about $2,000 to $3,000. So if you're talking about art, like real art, obviously that's not very good. So all of these sublimits of insurance, they need to have, if you have something over that amount, so let's take that bike, for example. If you have a $10,000 bike, then you're going to want to schedule that on your insurance policy, which means you're removing that bike from the situation and you're posting it on the deck page of the insurance policy saying like, this bike, this model, and this is the additional premium I'm paying for it. So if anything happens to that bike, I'm going to get paid because it's written down here. Same with the jewelry. Have your ring on there. Artwork, if you have a certain artwork, put it on there. So what you need to be prepared to do in this case is make sure that you have if we have a ring, you go to a gemologist and you have an actual evaluation done on that ring. That needs to be done for anything over about $10,000 with most insurance companies. They'll say, I need to see a gemologist report on that ring. And you send that in, and then again, it's posted on the deck page. The bike example, usually you just need a receipt showing like, hey, I bought this bike for 10 grand, put it on there, whatever, you know?
The day you see, Peter, that I've got a receipt for $10,000 for a bicycle.
I was going to say the day I see you have a receipt for a ring for Brenda, I'd probably fall off my chair.
Yeah, sorry, did you see one there? Okay, just checking on that. I don't see one either. Okay. She better not watch this podcast. Okay.
Yeah, fair enough.
Let's move along before I get into more trouble here. So what happens here to your coverage when you have what they call an act of God? All right. The BC floods. I mean, Peter, you brought this up earlier on in this. Okay. The summer fires, all of it. These are acts of God. What happens then?
Yeah, it's a funny thing with insurance. In insurance, you know, there's definitely they're quite clear on issues like this. So the fires that happened there, that's in insurance, that's not an act of God, because a fire that affects your house, whether it be from your neighboring property or from the forest that's behind you, that fire is included in that policy. It has to be by law. So you're fine with that. The only fire that wouldn't be included is something that was intentionally caused to the home. With flooding, I'm going to go back to what I said earlier. If it's fresh water, you're totally fine. If it's salt water, you're not so fine. Yeah. So there are certain areas of the valley and of the lower mainland that do not offer certain coverages. Like, it's really hard to get earthquake in Richmond.
That should be sinking insurance, I think, or something like that.
Yeah.
When the land liquefies.
It's really hard, believe it or not, in some parts of Langley to get overland water. And when they do, it's in some parts of Langley, and a lot of it, I think, is, with your basement and stuff, if it leaks through the foundation and comes into your basement, a lot of that is like, what do you call it? It's not an immediate eruption. It's like wear and tear. It's like slowly coming through and easing through into your basement. And people claim on that, obviously, because carpet was not wet yesterday and now it's wet. So what's happening? But they'll do some investigation and realize, like, hey, you didn't have the right drainage around your thing.
I had this happen about 30 years ago, actually, in a house I had in Coquitlam.
Okay.
And there was a couple of cracks in the foundation, but the house was older. And the old clay drain tiles we all remember, which back up, and they fill with dirt eventually. Well, and you get a lot of rain in Coquitlam. And in one corner of the basement, we noticed it was wet. And sure enough, they said, "Oh no, you've got to redo your drain tile and blah blah blah, and the foundation is cracked and da 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 da." And it was just easier. I hired a guy, a labor guy, to dig up all the way around the house, all the drain tile, and put brand new drain tile and gravel in, and seal all that concrete from the outside. So because it gets concrete, people don't realize concrete is porous and it will eventually crack. And so you need really good drain tile. And back then they did not have all that dimple board and whatnot that you see now in building, all that black stuff that looks like an egg carton on the outside of the house. They didn't have all that back in the 60s on houses. They just threw a little tar on the outside and there you go. Bob's your uncle. But I've had that happen and it's amazing. So you're buying an older house, and I've had this with clients. I said, "How old's that house?" And I said, first thing I tell them is check the drain tile, because you're just begging for a flood in an older house.
Yeah, I agree. And, this goes back to what we were talking about earlier about having those conversations and figuring out, like, is earthquake right for you? Yes or no? Is overland water right for you? Yes or no? It really depends on everybody's situation, right? And we want to make sure that everybody is setting themselves up for success when the worst thing happens, and if they can financially sustain that loss, and if it really is that important to them or not in coverage sense.
Here's the last thing I'm going to throw at you. How much has our attitude about everything that we've just been talking about here changed in the last 12 months? Man, because it's changed for me, man. It's changed for me. Everything.
Yeah.
Insanity.
Yeah, I think it's changed a lot.
Yeah.
I think for both sides of the coin. I mean, guys that are offering it, like my company, and people that are buying it. I think people are a lot more willing to talk about the different coverages that are available and want to know more about it, because there's just so much that's been happening. And also, obviously locally in BC, that through COVID, the market's been crazy. So everybody's wanting to know what's covered and what's not covered, and what should they be considering when they're moving, and et cetera. And then the floods happen, and they want answers on, is it covered, and why was I not, offered this coverage, and et cetera. I think people's attitude towards it has changed a lot. It's like anything though, right? I mean, I think there's going to be people that went through something that was really tough, and then they turned to the person that they thought had it covered, and it wasn't covered. So that's really going to burn them, and forever they will hate the insurance man. And then there's people that experience to the good side of that, and they'll be loyal.
Well, I'll tell you what, Josh, Peter, great information on all this stuff. And man, this, like I said, the timing could not be better. What we've gone through over the last year and a half has just been insanity. And man, I'll tell you, we really appreciate you coming on the show and giving us some insight. Brilliant stuff. Great work. Great work.
No, absolutely. No problem at all.
Thanks, Josh. I'll be in touch so we can put a checklist together to make people's lives easier, and we'll post it and just educate people to, take some responsibility, look after themselves, but if nothing else, point them in the right direction to make sure they get the right coverage for them, and just knowing the difference. I mean, knowing what, this is only going to cost you an extra $100 a year or whatever the case may be. Especially in BC, where, you got the average home is a couple $1 million nowadays. Yeah. Well, not BC, but Lower Mainland for sure. Making sure people do their homework. So I much appreciated you taking the time today.
No, thanks for having me, you guys. It's a lot
Thanks
of
so
fun.
much. That is episode 13, and we'll be back soon with episode 14. That's a threat. It's not a promise. It's a threat. Thanks as always for following and sharing us on your favorite podcast platform and YouTube. If you have a question for Peter, just go to yourmoney@everythingfinancial.com. Gentlemen, again, thank you very much.
Thanks a lot, Dave.
Adios.
Thanks, guys.